welcome to this webinar on financial regulation and macroeconomic stability in the Nordics, where this year's issue of the Nordic Economic Policy Review will be presented. My name is Lars Calmfors. I have been the chief editor of the review for the last 3 years. And let me first say a few words about the review. See if I can find my presentation. The review has existed since 2009, when it was launched by the Nordic Ministers of Finance. It is published by the Nordic Council of Ministers in cooperation with Nordregio, a research institute under the Council. The review is managed by a steering committee composed by representatives from the 5 Nordic Ministers of Finance. This is the objective of the review: to make the latest economic research accessible to decision makers as well as to a broader audience, and to contribute to Nordic knowledge exchange on economic policy issues and challenges. The objective is fulfilled by commissioning papers from leading academics on policy issues that are highly relevant for the Nordics, and by having these papers commented by other academics as well as by policymakers. Not a high-frequency journal. There is only one issue per year. Each issue has a particular theme. This is a list of recent themes: youth unemployment and policies against it, the future of the Nordic welfare state, labor market integration in the Nordic countries, increasing income inequality in the Nordics, then last year, climate policy in the Nordics, and as you all know, this year, the topic is financial regulation and macroeconomic stability in the Nordics. The next issue in 2021 will be the responsibility of Harry Flam, who is taking over as chief editor. The planned theme for this year is housing markets and housing policy in the Nordics. The motivation for this year's topic, which was chosen early in 2019, was that more than 10 years had passed since the start of the global financial crisis in 2007-2008. The crisis led to the imposition of stricter financial regulations in the Nordics as elsewhere, designed both to reduce the risks that financial crises occur and to improve the capacity to handle crises if they do occur anyway. As there seems to be a major economic crisis occurring approximately every 10th year, we felt that this could be an appropriate time to evaluate the resilience of the Nordic financial sector and review the appropriateness of various policies affecting financial markets. The background, of course, was that the worry in many circles regarding rising real estate and other asset prices and increasing household debt in an environment with very low interest rates. The issue contains 6 articles. There's a short introductory summary by Peter Englund and me. Peter Englund, who's a specialist in financial economics, has served as a guest editor, and he will do that also next year. Jesper Rangvid from Denmark writes about how stable is the financial sector in the Nordic countries today. 2 Norwegian economists, Martin Gulbrandsen and Gisle Natvik, about monetary policy and household debt. The relationship between macroprudential policy and household debt, mainly in Sweden, is analyzed very thoroughly by Lars Svensson, who argues that many of the policies designed to reduce household debt, for example, through amortization requirements, are in fact misplaced. Then 4 Finnish economists, Esa Jokivuori, Vesa Vihriälä, Kimmo Virolainen, and Hanna Westman, analyzed the new bail-in rules and new bank resolution framework in the EU, which have been adopted in order to deal with potential bank failures in in the future. Finally, then Karolina Ekholm will write about writes about pros and cons of participating in the banking union in the European Union, even though it's mainly about the consequences for Denmark and Sweden, who are outside the euro area. We shall have presentations of 3 of the articles here by Jesper Rangvid, Vesa Vihriälä, and Gisle Natvik. The reason why we picked those 3 papers for presentations is that they appear to have the greatest relevance in the current situation as it has developed with the corona pandemic. The papers were all written before the corona crisis, so they do not take the crisis explicitly into account, but they still have a lot to say about the resilience of the financial system to any type of shock and the possibilities to handle a financial crisis were it to occur. When we discussed preliminary versions of the articles at the seminar in Helsinki last December, there was some discussion of where the next economic crisis affecting financial markets might originate. It's probably not a surprise that a global pandemic was not mentioned by anyone as a candidate, even though the virus was probably already then spreading in Wuhan in China. But we did not, of course, know that. Now, it's rather natural that one tends to believe that the next crisis will be like the previous one, but it seldom is. And this is, of course, quite normal, since it's the nature of crisis not to be foreseen, because if they were, they would probably never happen, as steps would be taken to prevent them. The global financial crisis in 2008-2009 originated in the financial system and then spread to the real economy. This time, the crisis was a truly exogenous disturbance hitting the real economy, but it could in the end have very serious ramifications also for the financial system, which could then possibly worsen the impact on the real economy. This is a fear that many of us have. So for this reason, we have also included a panel discussion in the webinar exactly on this topic. Could the corona crisis trigger also a financial crisis? We have asked 2 of our authors to take part in this discussion. We have also invited 2 external participants. Well, I shall not talk much longer now. Instead, I shall give the floor to our first speaker, who is Professor Jesper Rangvid, who will briefly present his article on the robustness of the Nordic financial sector today. Jesper is a professor at Copenhagen Business School and was responsible for an inquiry into the causes and consequences of the Danish financial crisis in the aftermath of the global financial crisis. So please, Jesper, the digital floor is yours for the next 15 minutes, please.
Thanks a lot, Lars. Thanks for the introduction, and thanks to the editor, Lars and Peter, for inviting me to write the paper and also to make this presentation here. I will share my screen now, and I would like somebody to say yes if they can see the screen, so that I know that they can see it.
Unfortunately not, Jesper. There's just a black background at the moment.
Let's try again.
And I will also take this opportunity to ask all participants to turn off your cameras in case you haven't.
Do you have it now?
No.
This is very strange. Okay. Still not.
There we go.
Joanna,
Yes.
do you have it now?
We can see it now.
Strange. Okay,
Yes.
Okay, perfect. Thanks a lot. Okay, again, thanks for the opportunity, and sorry for this small technical issue, but that's I think we're all used to that now with all the Zoom meetings and Teams meetings and so on. Anyway, the title of this short presentation is How Stable is the Nordic Financial Sector? And exactly as Lars just mentioned, I think it's important to say, of course, that the paper was written in autumn 19, and the latest version was handed in February this year, meaning before the Corona crisis. So it doesn't deliberately talk about the Corona crisis, but we will do that in the panel afterwards. The first one, you can say, why is it important at all to discuss financial crisis and stability in the financial sector? And I think what I try to do in these two slides is the first thing I do in the paper is exactly to address this question. Why is that important? And I think the point is that financial crises, when they occur, luckily they don't occur that often. Lars said with a frequency of around 10 years, and I think that that's a suitable way of describing it. But when they do occur, they typically are associated with enormous economic consequences. We know from research that recessions that occur at the same time as there are financial crises, they are typically both deeper and longer than other types of recessions. And what I do in the paper is to try to measure the cost of financial crisis in the Nordics. I do that for Denmark, Finland, Norway, and Sweden, and I do that for the crisis in 90 and in 2008. And I just present two graphs here, Finland on the left and Denmark on the right. And the way economists and the way we do it in this paper is typically we say, what would have been potential or hypothetical developments in economic activity had there been no crisis, and then contrast that with economic activity that actually did occur after the crisis. And you see Finland around the crisis in the early 90s on the left-hand side. And what I do is I show real GDP in US dollar to compare across the Nordics, and then I do that before the crisis, and then I calculate a hypothetical real GDP had no crisis occurred. And the way I do that is that I project GDP after the crisis with the growth rate of GDP before the crisis. And the point is, of course, to say that you see crises are typically associated with large drops in GDP, but perhaps even more important, rebounds after crisis, they are typically much slower and they take very long time. In these two crises you see here, Denmark and Finland, even 10 years after the crisis, GDP had not caught up to the level that probably would have been there before the crisis. And I calculate that the cost in terms of GDP often corresponds to 1 or 2 years of GDP. So crises are incredibly important and costly, and that's why it's important to study financial stability, because it has real economic consequences if there's no financial stability. The next thing I do is I say, yes, okay, so it's very important, but it's also very difficult. Exactly as Lars said, and as I also write in the paper, I mean, crises are almost per definition unpredictable. I mean, if we had seen a crisis coming, we would obviously, politicians would obviously take action to try to prevent the crisis. They're almost per definition non-predictable. And I just have here two quotations to kind of illustrate that. The first one is, so I think it actually summarizes it quite well. The Elizabeth, who in November 2008 said, it's awful, the financial crisis in 2008, and why did nobody see it coming? I think it summarizes the sense that we're at that point in time. It was such a deep recession, the worst since 1930, and nobody had seen it coming. But we can also be more so specific and ask those that actually really evaluate financial stability. And I just have this quotation from Denmark. This is the Financial Stability Report, the second quotation down there. The Financial Stability Report of the Danish Central Bank, Nationalbanken, in 2008. It was published in mid-May 2008, I mean, just a few months before the outbreak of the financial crisis, and actually just 1 month before the first Danish bank ran into trouble in June already. And the first headline, it was the title of the Financial Stability Report in May 2008. The title was Robust Financial Sector in Denmark. And you know, the Financial Stability Report is there to evaluate financial stability, and they had used lots of pages and analysis on that, and they found out that, or they concluded that it was And it was very, very clear that the financial sector was not at all robust just a few months after the crisis. Of course, the whole Danish sector, financial sector, like anywhere in the world, or at least in many countries in the world, faced large problems. So this is important because it has real consequences, but it's also difficult. With that in mind, my task nevertheless was to do that, to write a paper on how stable is the Nordic financial sector. So I try to do that, of course, with these two caveats that I have just been mentioning in mind. And the first thing I do is I noticed from the academic literature and also from the Nordic experiences, one of the key indicators that typically are associated with future financial stability. And again, this is of course not a perfect indicator because it is difficult to predict crisis, but nevertheless, one of the indicators that literature has shown typically develops before a crisis. And that's the growth rate in
Jesper? Excuse me,
yeah.
Are you still on the first slide? Because we still see the one with Finland and Denmark. I got a comment here asking about that.
I'm certainly not on the first slide. I'm on the fourth slide. This is really, really strange. I'll try to share again. Joanna, I sent you my presentation. Do you have it?
I have it, so I can share instead.
If it doesn't work now, then I think that's better because given that we have these problems. Do you see my slide now?
No.
Okay, perhaps Joanna, it's better if you do it so that we don't have this technical issue.
Let's see. We are on page 4. Is that correct?
Yeah.
So I'll start sharing.
Page 4.
And it also seems that your connection is slightly bad, Jesper, because the sound is breaking up, and we're also getting comments on that.
Well, this is fantastic. Okay, let me go to another room. Let me go to my living room. Let's see if it's better over there. And then we can start sharing the presentation. Thank you. Perhaps just very, very briefly, slide 2. Can you do that? Joanna, can you hear me?
Yes, I can hear you. I have gone back to slide 2. Can you see that?
Nope. It's on slide 4. Okay, thanks. Just to very briefly say, this is what I mentioned. I calculate the cost of financial crisis by taking the difference between actual GDP and potential GDP. Can you then go to slide 3, Joanna? Next slide. Can you go to slide 3? At least.
I am trying. Let's see. There we go. Can you see that?
Not on my. Yes, thanks. And these are the two quotations that I showed you or mentioned, the Queen and the headline from the Danish Financial Stability Report. And then to slide 4, Joanna, please. Okay, thanks. So what I show you here is I show you the growth rate in real credit to the non-financial sector. And as I mentioned, it's one of the indicators that nevertheless has seemed to predict somehow financial crisis, even if it's not perfect. And what you clearly see here is I show these growth rates, it's quarterly growth rates in real GDP. I show it for Finland, Denmark, Sweden, and Norway. And what you see is that before the crisis in the early 90s, there's a clear tendency that growth rates, they are increasing, that banks are lending out more and more. And you see the same pattern before the crisis in 2008, also an increase in lending growth rates from banks to the non-financial sector. So also for the Nordics, and it's also in the paper I discussed the differences between the different Nordic countries. It's not this, they have not all been affected at the same time by the same types of crisis, but I nevertheless think it's somehow striking how similar these growth rates are across the Nordics. And how they are actually increasing before financial crisis, like we have typically seen in many other countries. Then, of course, the point is now, where are we now? If you look furthest to the right in the graph, and you have the latest observations, it's pretty clear that since the financial crisis, there's not been any tendency, basically, that growth rates... Oops. Can you go back to slide 4? There's not been any tendencies that growth rates have been increasing. There's been a little tendency in Sweden. It is this blue line or whatever it is, but basically growth rates in the Nordics seems to be somewhat low and somewhat stable. So one of these typical indicators is at least not in this sense flashing red. Can you go to slide 5, Joanna? The next thing I then do is say, okay, and one of the key lessons, obviously, from the financial crisis in 2008, and that was that banks were certainly back then not resilient enough. It was clear to everybody, I think, that banks, given the risks that they had taken on and off their balance sheets, were not stable enough, were not resilient enough to face the risks when these risks materialized due to the fact that the financial crisis was so intense as it was. What has obviously happened since the financial crisis is that there's been an enormous amount of regulation of the financial sector based on the learnings from the financial crisis. And I discussed that in the paper, all these many types of regulations of the financial sector that we have had. And this is just one graph to kind of illustrate that. Is the capital ratios of the largest or some of the largest Nordic banks, those that participate in the EBA stress tests. And the point is simply to say that capitalization of banks, these are tier 1 capital in relation to risk-weighted assets, has been, in most types of banks, has been at least doubled since the financial crisis. And in terms of regulation, it's actually more or less a 7th-fold increase in requirements to capital and a clear increase in capitalization. I also discussed several of the other most important types of regulations that have been introduced, the liquidity regulations that have been introduced, the restructuring and resolution regimes, meaning that even if it nevertheless should go wrong, then how can we then avoid that banks will need to be rescued by governments? How can we wind down banks if they run into trouble without taxpayers having to pay the bill? These restructuring and resolution regimes. I discussed the stress tests that are conducted nowadays that are much stronger than they were before the financial crisis. And of course, also in a number of countries, we have also had a number of different macroprudential tools, where, as Lars Heikensten discussed in the paper, some of them are perhaps, could perhaps be done differently, but in general, many of the macroprudential regulations also reduce some types of risk. So basically, point being that an enormous amount of regulation has taken place, and I think it's fair to say that the financial sector today in the Nordics is more resilient than it was, at least when we entered the financial crisis in 2008. That's my clear conclusion. Next slide, please, Joanna. A lot of discussion when we talk about financial stability in the Nordics, and that deals with household debt and house prices. So I have the slide here where you're on the left-hand side, you see the measure of household debt in relation to disposable income in the 4 largest Nordic countries. These are these OECD data. And Denmark has also been different than the rest of the Nordic countries in the sense that Denmark has also been a highly indebted country. I'm also a Dane. We also have a lot of pension assets. We have a very large pension savings. So Denmark is an outlier in this sense. Denmark has actually been reduced leverage on the household side since the crisis. But I think more in Sweden and Norway, also Finland, it's discussed a lot that household debt levels, they have been increasing throughout the last many years. And this is what I show in this graph. Alongside with increases in household debt, we have seen house prices increase in the Nordics. Basically for the last 30 years, I would say, house prices, they have just been increasing. Also real house prices have basically just been increasing for the last 30 years in the Nordics. So I discussed this, and I think there's 2 ways of looking at this. And the first one is, of course, when house prices and household debt levels, they are higher, and then households, they are more fragile per definition. When they are more leveraged, and then they are more fragile. But I think another way of looking at it, which I also think is important, is that this is not a good predictor of when a financial crisis occurs. I mean, house prices and household debt levels, they have been increasing now, as I mentioned, for 30 years in Sweden, Denmark, and Norway. And that means, if you said 20 years ago, now house prices, they have been increasing for 10 years, probably soon we'll have a financial crisis, and then you would have been crying wolf, right? Because house prices and household debt levels, they have just continued to increase. So what I'm saying is I cannot say whether house prices and household debt levels, they are too high. than they were 10 years ago, but 10 years ago they were also higher than they were 20 years ago, and 20 years ago they were also higher than they were 30 years ago. So I think it's difficult to use this as a predictor of prices, but of course it indicates that the system is more fragile in that sense. And that takes me to my probably final and main point, if you go there. Next slide, please, Johan. And that is one of the reasons why we have seen house prices and household debt levels increase so much, and that is because interest rates, they have just been falling. So also throughout the last 40 years or so, interest rates around the world, they have just been falling, and what I show you on this slide is not just to indicate that the policy rates of the Nordic central banks, and we see how they have just been decreasing, and in Denmark they are negative at the moment. Sweden, you have just come up to zero again, and in Norway and Finland they are low. But still positive. I mean, ECB rates are also, some of them are also negative, by the way, at the moment for Finland. The point being that when interest rates, they are very low, and that obviously contributes to high household debt levels and high house prices. And it also means that when the interest rates are low, you also can afford a higher debt, of course. So in that sense, there's a good reason. Why house prices and household debt levels, they have increased, because interest rates are so low. Next slide, Johan. And I think I think there are three things that worries me about the low interest rates, and I think that's my main concern, that these are the low interest rates. That's my main concern. So when I look across, when I look at what about the financial sector, when I look about households and so on, where's the main risk? And I think the main risk is those effects that are associated with low policy rates. First of all, when policy rates are so low, there's very little room for monetary policy if a crisis should occur. And this is exactly what we are seeing at the moment. We are in the worst recession, hopefully reasonably short-lived, but we're in the worst recession probably ever. Much worse than the 2008 crisis. The drop in GDP is larger and so on, and also worse, actually, I would say, on the short term. The drop is, at least on the short term, larger than the 30s. And nevertheless, policy rates in the Nordics, policy rates in Europe, they have not been reduced at all. Then you use other types of monetary policy, but the most important monetary policy tool you just cannot use anymore. So this is, of course, a concern. And then it's certainly a concern if interest rates should rise. Yeah, then we are sitting there with all this household debt and all these high house prices. And should interest rate rise, of course, that will create some concerns with respect to the sustainability of the household sector. And finally, should interest rates stay very low, which they perhaps do, then that hurts profitability of banks. And that brings me to my very final slide, my conclusion, and that is that basically I would say I think the financial system and the financial sector in the Nordic seems to be reasonably stable. I mean, banks are better capitalized, the system is better, it's more resilient, lots of good regulation, a lot of regulation, but also lots of good regulation has been implemented after the financial crisis, and lending growth is not very high. Of course, household prices and household debt levels are high, but if interest rates stay low, that is perhaps fine. So the big concern here, at least in my view, and I saw also in the view of my discussions at the conference, was that the low interest rates, they are a cause for concern. And thank you, and sorry for running a little bit late and for the technical problems.
Well, thank you, Jesper, for your presentation. And we do have to apologize for the technical problems, but those are real effects of the corona crisis that somehow hit us all. I guess an obvious question, but we will return to this, is if you make the same judgment, Jesper, about the robustness of the financial sector now that we are in the corona crisis. And the problem probably is not household debt, it's probably commercial debt that could be the problem. But I will not give you the chance to respond now, because you have the chance later on. But that is certainly an issue that we want to hear your views on later. But we will go on then to the next presentation, which will be made by Vesa Vihriälä, on how the bail-in rules and bank resolution framework introduced in the EU is likely to function if they are put to a test. Vesa is a professor at the Helsinki Graduate School of Economics and former head of Research Institute Etla in Helsinki. So please, Vesa, the word is yours now.
Could we also just ask Björn Gudmundsson to turn off his camera, please?
Okay, thank you very much for the kind invitation. I try to share my slides. Hopefully that functions. Do you see them?
Yes.
Okay.
And I think, unfortunately, maybe it's better if you don't use presenter mode, because that there seems to be some kind of bug in changing slides.
All right. Okay. Let's go on this basis. So the topic of my discussion today is bail-in rules. That is a way of making bank creditors to bear part of the burden of bank failures. And the starting point of this discussion in our paper was the observation that for quite some time the standard approach to banking problems was one of bailouts. That is, the authorities considered the financial stability considerations of banking crisis so serious that they resorted to bailing out bank creditors, and in some cases also bank owners, in order to limit or constrain the short-term implications of financial problems in banks. That, of course, led to high cost to taxpayers. It was considered unfair also on other grounds. And then there was this economic argument that, well, even if you can constrain the immediate impact on financial stability and the macroeconomic, real economic consequences, the longer-term effects of that sort of bailout policies could be detrimental, in the sense that they create incentives for banks not to constrain their risk-taking, but rather perhaps to take excessive risks, and that would then in the end lead to more financial instability. So these arguments were, I think, the background for what happened in 2008 in September, when Lehman Brothers was about to fail. Then the decision was taken in the US to allow it to fail. The consequences, however, were so bad that the US resumed immediately bailout policy, which extended to many non-financial corporations at the same time, and also the European countries followed the same approach. Now, given that bailout policies had been bad, allowing banks to fail had been bad, of course, then there was the question what to do about it. And the rather obvious conclusion was that we need to reform our financial regulation, and that led basically to a extensive revision of bank legislation globally and also in Europe. An important part of that was higher capital requirements, but also in other respects regulations were tightened and supervision was tightened as well. One particular aspect was that it became sort of fashionable and considered more and more important to have a regime where you could restructure banking institutions which are in difficulties in a way which would involve some participation of bank creditors in the costs. That is bail-in policies. And here there are three important questions from economic point of view. One is if you want to do that sort of thing, that you allow incur losses, so how much overall loss absorption capacity, including equity, contingent capital, and then these instruments that could be called bail-inable debt, how much in total you should have as a share of bank liabilities? That's one important question. The second question is what would be the optimal composition of that loss absorption capacity? How much in particular capital and how much bail-inable debt? And the third question then arises quite naturally, how can you do it all in practice, given that banking problems are oftentimes very quick, you have to take decisions quickly, and the decisions are complicated. So these three things: how much total loss absorption capacity, what is composition, and how to actually do it, the whole thing in practice. Now, concerning the second question, which is economically interesting, Of course, there are people who argue that the only thing we need to have in place is enough bank capital. However, there is another argument which says that bank capital is costly, equity capital is costly, and therefore it reduces credit supply, which means that even normal times you could have detrimental effects of excessive capital requirements. And the other thing is that if you impose very harsh conditions or regulations on banks which are regulated, then some of the banking business, the financial intermediation that takes place, may drift into something that you call shadow banking in institutions which are beyond regulation and supervision, at least to the same extent. So these two considerations basically lead to the conclusion that perhaps it's optimal to have both bank capital, equity capital, and bail-inable debt. What the exact share should be, that is much more difficult to decide, but you preferably have both on the liability side of bank balance sheet. The key question is not, however, what is the precise share of these different types of loss absorption elements on the balance sheet, but how do you handle an acute resolution situation in such a way that it doesn't lead to financial instability. It doesn't spill over the problems of one banking institution, which is handled through resolution and bail-in, doesn't lead to contagion in the financial system as a whole. And obviously there are different avenues of contagion. One is the direct financial linkages that exist, given that the liabilities of a given financial institution oftentimes are assets of another institution. So if you incur losses, that will then spill over to some other banks. The second thing, which is much more difficult to handle or get grips with, is the uncertainty about these consequences for other institutions in a complex financial system. You don't actually know exactly what the positions of different institutions are, what the balance sheets are, what the linkages are, and therefore if some bank hits problems, that gives rise to doubts about other banks, and certainly that can be aggravated if you don't know how these institutions are linked to one another. So a natural response in that sort of situation is fear, flight to safety, fire sales, which will have an impact on asset prices, which will further aggravate the financial distress in the system, having macroeconomic real consequences, and you have a vicious circle. So this is the main constraint of any bail-in approach in handling banking problems. The unfortunate thing is that we have rather little empirical evidence about how these sort of structures that have been recently created would function in a real situation. The evidence that we have about bank resolution and bail-in is as I said, rather limited. There is some evidence. A couple of papers have been written about what has happened in the aftermath or immediately after bail-in decisions in a given banking institution. And the general outcome of those studies is that yes, other banks have reacted, or the market has reacted with regard to other banks, in the sense that the stock prices of other financial institutions have declined, and also the CDS spreads, which measure the riskiness of bank debt, have increased. However, these changes haven't been very large, and they haven't been long-lasting. There's one sort of case study or case which is important, and that's Cyprus in 2013, where two major banks were subject to bail-in, and it had the bail-in decision had real consequences. There's no question about that. At the same time, the consequences were not overwhelming, in the sense that if you compare it to how Cyprus did in the following years, it wasn't that much different from what happened in other countries, neighboring countries like Italy or Greece. So in terms of GDP growth, for example. There have been some simulation studies. One in particular we mentioned in the paper, which has studied how much a bail-in in a big European bank would affect the situation in other big European banks. And here the outcome was quite positive in the sense that even though you had a major bail-in, I think it was of the order of 5% of bank balance sheet, no other bank would fail because of that sort of bail-in directly. However, this analysis only considered direct effects through the balance sheets. It did not have anything to do with the sort of fear factors, what would happen to expectations in the case of such bail-ins. There was a new paper which we couldn't take fully into account in writing up the paper we have in this journal. It is by Beck, Radev and Schnabel, and it's very interesting. It came out in May. It looks at the impact of different resolution regimes on systemic risks, and the conclusion is sort of worrisome in the sense that they basically conclude that more comprehensive bank resolution regimes, setups, may exacerbate the effects of system-wide shocks. That is, if you have in place a very credible banking resolution system, including bail-in, that may lead to expectations that indeed is activated and it will have a detrimental effect on the system as a whole if there is something that happens in that particular country. And also, I think it's fair to say that many experienced policymakers and financial market experts tend to be skeptical about bail-in, particularly when there is general economic weakness in the system. These sort of conditions we are facing right now. These were what I discussed so far were basically sort of theoretical aspects and then some empirical observations about actual bail-in cases and what policymakers have been thinking about those things. Another thing is how do you do the whole thing in practice? And there are formidable practical challenges in bail-in actions. You need to be able to take the decisions very quickly and promptly over a weekend typically. Secondly, you have to make sure that the remaining institutions, including the one that is subject to bail-in, have enough liquidity to survive in the following days, weeks. You have to come over all the legal uncertainties which exist always in these sort of cases. And the issue is if you have a banking institutions that is active in different jurisdictions and it may have capital in different parts of the operating area. How do you make sure that that capital is effectively and those bail-inable debt are effectively used to handle the situation, to bear the losses? And all these things suggest that a clear legal framework, strong administration, capable administration, and also political backing for the decisions to be taken is very important for a successful implementation of bank resolution and bail-in actions. In Europe, we have a new system in place since 2015, and I don't go into any details about that. Let me just say that it basically involves two types of things. One is resolution of actual cases, and there you have to be, as I said, very quick, and you have to take complex decisions. The other one is that because of the great speed you need to have in actual situations, you need to plan very well in advance what we are going to do in acute crisis. That's one aspect of the planning. The other aspect of planning is that you need to make sure to all market participants that they know what is going to happen, so that you can avoid excessive fear in the case of when you actually have to resort to bail-in. The Nordic context is complex in the sense that our banking system is dominated by large institutions, and banks are very important for the economy as a whole, and all the banks are also very interconnected. This basically means that whenever we are going to have a situation in which bank resolution and bail-in is a serious option that needs to be considered, we actually always deal with a systemic issue. So that means that all the difficulties that are associated with systemic problems are present in the potential Nordic cases. The other side of the coin is that resolution planning and administrative preparation seems to be very good in the Nordics. Currently, all major banks meet the MREL requirement, that is, they have enough loss absorption capacity compared to the requirements, and the authorities are also cooperating very well. So in a way, the Nordic situation is very challenging given the nature of the banking system. On the other hand, the authorities seem to be relatively well prepared, and the bank's capital positions are, including also bail-in debt elements, are pretty good, as also was pointed out in the previous presentation. So in this way, I think it is sort of a challenging situation for the Nordics, but at the same time, I think one could say that we have done what can be done to prepare for such a situation. Here I have briefly collected the conclusions of what we have in the paper. I just summarize that the new approach of bank resolution based on bail-in is very attractive and natural conclusion, conclusion of the difficulties we have had with the earlier approaches. At the same time, it is clear that it is very attractive for individual cases, idiosyncratic cases, but how attractive and implementable that is in really systemic cases when the economy as a whole is in deep trouble, when the economic system is fragile in general, in the situation where we are living right now. So I would say that the jury is out. We really don't know how it would function in this sort of situation. Thank you very much.
Thank you, Vesa. I believe that you were a bit more skeptical about how bail-ins would work in a systemic crisis in your presentation than you were in the article. So I would like you to comment very briefly on that. And then, well, you are not coming back in the panel discussion, so I could also ask you for a very brief answer or very brief response to the question of whether you believe that the new bail-in and resolution frameworks will be put to a test now, or will it not be put to a test? What is your view on that? Very brief answers.
Okay, thank you. I guess I might be a little bit more skeptical with regard to sort of systemic situations than I was when we were writing up the paper. I think, as I tried to hint, I don't think there are any doubts that if we have idiosyncratic problems, we can handle situations even in the case of rather big banks. And I think in that sort of situations, the system will be put into test. The authorities will resort to bank resolution based on bail-in. I think that's quite plausible. But if we have a system-wide situation where you can believe that a large part of the European banking system are on a shaky basis and the financial system is stressed, I'm not so sure. Honestly, I don't know. I don't know what would happen, and I don't know to what extent the authorities would want to try. I think there is always a sort of tendency among the decision makers to try to live to the next day. If you like, want to, if that is the sort of, they want to be excessively cautious. There's a bias towards not having a big problem tomorrow. So that basically makes me believe that perhaps bail-in will not be taken as easily as might be the case otherwise.
Okay, thank you very much for those additional comments, Vesa. Then we have the presentation of a third article from the review. Gisle Natvik is a professor at the Norwegian Business School in Oslo, and will talk about how monetary policy affects households' debt. Do higher interest rates reduce household debt, as is the conventional wisdom, or is it the other way around, that interest rate hikes instead work to increase household debt and increase the fragility of the financial system? So please, Gisle, the word is yours now for 15 minutes.
Thank you. Can you see my slides?
Yes.
Great. So then I'll talk. Do you want me to turn on my camera, or I can turn it on? Tell me if the sound becomes bad, and I'll turn the camera back off. Yes, thank you. I'm going to talk about monetary policy and household debt, and in particular inflation and household debt. This is joint work with Magnus Gulbrandsen, who's a PhD student here at BI Norwegian Business School. So the motivation for this talk is pretty obvious. Household debt has increased dramatically relative to income in the Nordic countries over the last decades. So this is a graph from 95. It's the same as Jesper had, I guess. It's data from the OECD. And we just see that there's been this massive upward increasing trend in all the Nordic countries, with the exception of Denmark since the financial crisis. So debt has increased quite a lot compared to household income. So that raises the question if household debt is a relevant concern for monetary policy. Several central banks, like Norges Bank, they have argued that it's a concern. But why, out of the many potential concerns that you could think of for a central bank, why exactly household debt? Second, given if one agrees that household debt is a concern, then you would like to know how should we expect monetary policy to affect household debt, and in particular household debt relative to income or relative to the price level. So it's the real level of household debt. So then with a solid answer to that second question, we can address perhaps what we're ultimately after, sort of what characterizes a monetary policy that stabilizes household debt burdens over time in an optimal way. This is a very long, I think we're quite far from being at that point scientifically today. And basically to get to answering that final question, we really need to answer first a question like question 2 here. How does a monetary policy actually affect household debt? In our paper, we approach this with our paper is divided in two. So we first extract some useful lessons from the literature. It's a select literature review. It's kind of subjective. We picked a bit, and we're going to argue that the literature sort of points towards the need for a more nuanced view on how monetary policy affects debt. And then second, we turn to the Norwegian microdata and look descriptively into how monetary policy affects cash flows on debt. This is a very descriptive study. It's not really a study where we assess causality very deeply. So just to the first part, I'm going to go quickly through that now. On the literature review. So there's a first takeaway is that there's been an abundance of historical evidence over the last 10-15 years. Jorda, Schuler-Dick and Taylor in particular, and Mian Soufi and Emil Werner have a paper just documenting that historically, going back 150 years in a bunch of OECD countries, we find that household debt seems to matter for macroeconomic stability. So periods with sharp increase in household debt raise the risk of economic recessions, and given that recessions occur, they tend to be deeper if they were preceded by increasing household debt relative to income. The second takeaway is that once you start talking about, well, what's the role of interest rate, it's not that clear. Macro evidence like in particular, I'm thinking about evidence of the type that comes from VAR models, where you look at the correlation between interest rate changes and aggregate debt levels, or aggregate debt divided by aggregate income, something like that, and try to identify shocks to interest rates. And then the evidence is inconclusive on how interest rate affects debt. And the reason is pretty simple, that there's a numerator and a denominator. So yes, it might be that there is some effect on debt, but there's also a denominator, which is, for instance, the price level. So if you're interested in the real value of debt, or if it's the income level, so you're interested in debt to income, then monetary policy will tend to affect the denominator as well. So sort of if income goes up, well, income is in the denominator, so then the debt burden goes down. So if you tighten interest rates, then typically you'd expect interest to go down, income to go down in the short run. Well, then the debt burden it might go up because the denominator is going down. So it's not obvious how interest rates affect the debt to income ratio when you just look at macro data. And you can build simple models to explain why. And the reason would be in a simple model that, well, only few households actually refinance their debt every period. So for those households who are not refinancing their debt, they just follow some given debt contract. So really interest rates don't change much how much they repay of their debt, but their income is affected. And this was an argument that Lars Svensson pushed quite hard in Sweden. So the third takeaway we're emphasizing is we turn towards modern macroeconomics, I'd say, which is emphasizing more heterogeneity and looking at how to build macro from micro foundations when we're not just talking about theory, but we're also talking about data. So macro models where you can utilize micro data. And that literature has been there for quite a while, but the last 10 years it's accelerated, I'd say, and it's been looking a lot at monetary policy, and it tends to emphasize that that monetary policy affects household expenditure through other channels than just intertemporal substitution. Basically, that it's not just that interest rates go up, it will disincentivize borrowing, which is the conventional channel, but it will also affect households' cash flows. And that these cash flows might have a separate effect on stuff like saving and consumption. And that's likely to be the case for monetary policy and debt as well, that cash flows matter. And takeaway 4 here is very related to that, namely that there is a bit of micro evidence looking at how households behave, indicating that, yes, these cash flow effects are quite important for how monetary policy affects behavior. And we know that household debt is a key ingredient, of course, in this transmission channel, in particular if people have floating interest rate mortgages, as is common in the Nordic countries. So then if the interest rate goes up, indebted households will have weaker cash flows. Okay, so based on that, we say that, well, one should have a nuanced view on how monetary policy transmits to household debt. So how should we actually expect an interest rate change or an increase in interest rate to affect household debt accumulation? We'd say there are 3 channels. First, it will incentivize saving because now the returns to savings are higher. So that generates intertemporal substitutions, as it's called. Basically, that the price, the returns to saving has gone up. So now it's a good time to save, and then you should expect people to borrow less. This is the conventional logic, but it's likely to be rather unimportant, we claim. That's sort of based on this existing evidence on cash flows. The second, but it could be, it's an empirical question how important it is. The second channel is that an interest rate hike will reduce the cash flows of indebted households, like a negative transitory income shock. So if households for a short time have lower disposable income, they will part cut consumption and in part cut saving. And that would mean that they will repay less of their debt or borrow less. So that goes the other way around, And then the third effect there would be that, well, if you increase the interest rate and that affects inflation, that's what typical central bank logic is about, that and inflation targeting is about. You increase the interest rate to reduce inflation, well, then you will affect the value of real debt, so debt divided by the price level. Because of course you're not really interested in just the nominal value of debt, it's the real level of debt or the debt value of debt relative to income that matters. So here, by affecting inflation, you're affecting the real value of debt, and that's what we can think of as some call it Fisherian debt deflation, going back to Irving Fisher's work on the 1930s. So those are the three channels we're talking about. Particularly, we're going to do empirical exercises thinking about channel 2 and 3. There's a caveat here. There's house prices. We're not going to talk much about that. We're using Norwegian registry data covering the universe of Norwegian households from 1993 to 2015. It's at the household level. We have great data because Norway has a wealth tax in addition to an income tax. So we have high quality data on each household's balance sheets. And we observe assets, liabilities, income, household characteristics, and so on. And these data are third-party reported. This is just the first graph showing the income components of households that we're interested in. So on the vertical axis to the left, these are numbers for mean interest income, which is the blue line, and mean income expenditure or expenses, the red line. So and these are means across all households in each year. So this is in 93. So this says that in 1993, the level of mean interest expenses, this is deflated by the price level. So it's the real value of mean interest expenses for Norwegian households on average was 30,000 kroners. And here for income, the number was 1,000. So one striking feature is that there's a big gap here. So in a closed economy, you'd expect these two to be closer to each other or on top of each other. This is not only, we believe, explained by the fact that Norwegian is an open economy. So probably there's some part of this is that some interest income is hidden to a household. It sort of goes indirectly through, say, their pensions. And that's an interesting issue that we are ignoring here because we can't really directly observe it yet. And we see that one striking feature is that this red line, interest expenses, is remarkably flat, given that debt has increased that much. But that's, of course, because interest rates have gone down. So although the debt level has increased a lot, the interest expenses has not increased a lot. Household income, on the other hand, has increased a lot. That's the green line here. And it's measured on the right vertical axis. And the numbers here on the right vertical axis are about 10 times bigger than on the left axis. So it means that this level of household income is more than 10 times greater than the level of interest expenses. So another descriptive fact is just the distribution of debt. It's not really related to our exercise later on, but this is just an interesting figure where we see that the distribution of debt, it's not just that the mean level of debt that we saw in the first figure has increased, but of course we see that the distribution has changed a bit. So this is in 93, and we see that a lot of the mass to the left has shifted to the right when we get now to 2015. We have way more households with, say, 7 times the debt level. That is 7 times greater than the household income than we had up here. Okay. So first the question is regards cash flows and nominal interest rates. We ask, how do the components of disposable income, namely household cash flows, co-move with the nominal interest rate? We look at the mean real value of cash flows and the nominal interest rate over time, and we look at the differences in the data, so the growth rates of the data. On the left, so on the left axis here, we have the value of the change in total income. On the right axis, we have the change of the interest rate. So the red line in each of these 4 figures is the nominal interest rate. What this figure tells us is if we start in the lower right corner, we look at interest expenses. We see that interest expenses is not surprising, but it's just showing it very clearly, tracks changes in interest rates very closely. So when the interest rate goes up in Norway, the policy rate goes up, then interest expenses of households goes up as well. So that means that when the interest policy rate goes up, household cash flows are weakened for those households who have a lot of debt. Now, households have interest income as well. So we see here, there's also a positive correlation, but we see the blue line here varies much less than the blue line did over to the right, simply because households have less direct income from interest bearing assets. But these flows are not big enough to dominate total income up here. So this is total household income. And that's because total household income primarily comes from other income sources than interest expenses and interest income. So these up to the upper right left-hand panel, we have household income excluding interest expense and interest income, and then we see this is what drives it. Basically, earnings is what drives total household income. The other reason is, of course, these two lower panels, they go in pulled in different directions, so they cancel each other out to some extent. So interest expenses goes up, yes, but interest income goes up too. So those two cash flow effects cancel each other out to some extent when we're talking about means. Of course, there will be big distributional effects, and we go into that a little bit in the paper. But from that, we sort of conclude that, well, if you think about the components of disposable income, household cash flows, how do they co-move with nominal interest rates? We find that there's a distinct effect on deposit income and debt expenditure, what was in the lower panels in the last slide. And that's not surprising, of course, but these are insufficient to dominate total income, which is mostly driven by earnings. So it's kind of unlikely that there will be big effects of interest rates on debt accumulation via cash flows. It's still very loose at this point, but it's kind of just descriptively looking at the data. It's unlikely that there's going to be dramatic effects from household cash flows to debt changes. Okay, so the next question would be then, how does debt growth actually co-move with interest and inflation? So we're going to look now at the mean level of real debt growth, the level change, and we're going to look at interest rates and inflation over time. And we're going to look at first difference data. So here we have the red line here is the same as we had before. It's the change in the nominal policy rate. And over here to the right, the red line is the change in the real policy rate. And it's a realized real policy rate. So it's interest rate minus the inflation in a given year. And the blue line to the left is the change in real debt growth, the growth rate of real debt, and it's the change in it. What we see here is basically nothing. There is no correlation, or it's a very, very weak correlation. So it does not seem, just by descriptively looking at the data, that there's a strong association between nominal interest rate changes and changes in debt growth. That's, of course, there could be many reasons why that. There are, of course, a bunch of other factors affecting debt growth. But just from looking at the data, there's no strong pattern. If you looked at the right, actually, there seems to be a correlation, and these are pretty highly correlated. The change in debt growth, real debt, so this is debt divided by the price level. So the change in debt growth is pretty highly correlated with the change in the real policy rate. And the correlation is positive. So it seems that when the change in the real policy rate goes up, then the change in the debt growth goes up as well, which is kind of the opposite of intertemporal substitution. But so it's kind of surprising. Why is this going on? We see no association for nominal rates. So there's some association for real rates. Why is this? Well, it's all about inflation. So here is the red line here are changes in inflation. The blue line is changes in debt growth. We're still looking at the means in the sample. And then we see that when the inflation is, the growth in inflation is high, when inflation accelerates, the debt growth decelerates. Okay, so inflation goes up, the value of real debt goes down, or the growth rate in the value of the real debt goes down. So that means or you can plot it out like this. It's just the same figure again. We're now plotting it out, just inflation rate here and debt growth rate here, just to more clearly show the negative association between inflation, the changes in inflation, and the changes in debt growth. It's well beyond any interest rate association. Why is that? Well, it's because people who do not move, they tend to this is hypothetically speaking, but it's very consistent with the hypothesis that people who do not move are on nominal debt contracts. And as it is, people who do not move, those are the ones who are carrying the most of the debt. So to the right, we have people who move. For those, we do not see a strong association between changes in debt growth and changes in inflation. So here is not a very strong association between the blue and the red line. To the left, the red line is still a change in inflation. This is the change in the debt growth among households who do not move in a given year. And here we see that we have this strong negative association. And we can see that over here in the left panel. All right, just plotting it slightly differently. When the inflation rate goes up, debt growth goes down. And it's not significant for movers. So it's only for people who are staying, who are not moving. And this is what we can think of as Fisher dynamics. So it seems that inflation can be important in the sense that it deflates the real value of debt to some extent. And we do some more exercise in the paper to think about how different types of households and comparing them and so on, but I don't really have time to go into that now. Okay, so just to summarize, evidence from the last 10 years in it argues that household debt matters for macro, in particular for financial crisis. So it might make sense for central banks to think of the implications of monetary policy for household debt, but it does not automatically follow that monetary policy should target debt separately from other conventional policy objectives like inflation. In particular, going into the argument in a bit more detail, we argue that conventional monetary policy logic has it that monetary intertemporal substitution is important. We think that's not very consistent with recent macro evidence on monetary policy and debt, or monetary policy and consumption, it should say here, and it's at odds with recent evidence literature on monetary policy and aggregate demand. So plausible alternative channels are cash flow effects and debt deflation. The cash flow effects that we looked at in our data, they don't look very strong, but it could still be something going on. So it's related to this recent literature on building models with more precise micro foundations, emphasizing heterogeneity across households, and then building those using micro evidence. The suggestive patterns from Norway indicate that debt matters, of course, for monetary policy's cash flow effects. That's what we saw in the lower panels on one of the figures I showed. But it's unclear if there's any effect vice versa. It's not clear if these cash flow effects are big enough to dominate movements in household debt. But the Fisher effects of inflation on debt burdens are surprisingly visible. So it seems that inflation can actually matter quite a bit, in the sense that when inflation goes up, household debt burdens go down. There's one caveat. We have not looked into house prices. That's likely to be important, and it's a thing that we're looking into with future work. But for now, it is a preliminary, maybe a premature policy conclusion. But for now, based on how we see the literature and how we see the evidence that we've been looking at, then maybe the best thing is just to have a conservative approach, stick to targeting inflation, and that could in itself be important for debt stability through these Fisherian debt deflation effects. But then, of course, you need to target inflation at a sufficiently high level. Thank you.
Thank you, Gisle. I guess that many will find your article a bit provocative, since it is in conflict with conventional wisdom. I mean, the standard argument, I guess, is really about debt and house prices, that if you have lower interest rate, you will get higher asset prices, higher real estate prices, and therefore you will get more borrowing. Could you just summarize again why you believe that argument is not correct, if you do believe that?
I'm not going to. So claiming, I don't think based on what we've done, we can claim that argument is incorrect. I think it's quite likely to be something there. What we're calling for is what we call the nuanced view on the transmission. It's not clear with short-run changes in the interest rate, how that will immediately affect debt. I think these macro studies show that. The macro studies tend to find that when you increase the interest rate, then the debt burden, so debt divided by income, say, goes up in the short run, but a little bit down in the long run. Could be. You can build models consistent with that. But these, first of all, one should be aware that these effects often are quite muted, because households tend to have a lot of debt from before. So how they're able, their capacity to handle that debt is pretty important. So I think often in the discussions of debt, the implicit assumption is often that debt is like a flow variable that you can reset every period, and everyone can go out and refinance their mortgage and move around and sell 1 square meter of their house and rebalance their portfolios. But of course, that's not what people can do. It's very costly to move. It can be costly to refinance your mortgages. So a lot of households cannot do it immediately because they are up against some borrowing constraints, and then they follow some payment plans. I think that, first of all, I think that effects via house prices are very realistic and probably important, and we haven't looked into them in detail in the data yet. I can say from what I've seen in the data, very rough regressions, it seems that that's important. But the conventional view is often about intertemporal substitution, nothing to do with house prices. And that I think is of limit. That seems to be of limited importance, and I think that's what this Hank literature up here is also emphasizing. So that's maybe the strongest view. But I think there's a lot of effects going in different directions, and I think the conservative approach of sticking to targeting inflation rather than to trying to do too many things at once, I think that's a good idea.
Okay, thank you very much. I just wanted you to clarify this, since I think many people will be reflecting over this. Then this finishes the presentations of the articles in the review. So I want to thank Jesper, Vesa and Gisle for their presentations. I do hope that the contributions in the review will also be read. I believe it is in fact very good reading, and this applies also to the articles, of course, by Lars Svensson and Karolina Ekholm, which were not presented here today. Then we move to our next item on the agenda, which will be a panel discussion on the repercussions that the corona crisis in the real economy might have on the financial system. The panel discussion will be moderated not by me, but by my co-editor, Peter Englund, who will now hopefully take over if all the technicalities work. Please, Peter.
Okay, thank you, Lars. Am I on?
Yes.
Okay, so as has been emphasized, all the papers in the issue are pre-corona, and now we get a chance with this panel to reassess financial stability as we can see it a few months into the pandemic. So Jesper Rangvid in his papers shows these graphs that we are all familiar with, showing the huge real costs of the financial crisis. Now we have the opposite situation of a real crisis, and we want to assess what that can do to financial stability. But I think we should try to take the question a little bit further and reformulate it to say that is the financial sector in the Nordic countries strong enough not only to keep itself alive, but also to help support the real sector and avoid a deeper crisis. So to discuss this, we have a four-person panel, so Jesper will have a chance to come back and sort of rewrite his paper or reassess the financial stability situation as he sees it today. The three other panelists have one thing in common. They've all been at various times on the board of governors of the Swedish Riksbank. Lars Heikensten was the deputy governor and then governor between 1995 and 2005. He's now the CEO of the Nobel Foundation. Karolina Ekholm was deputy governor between 2009 and 2014, then went on to serve as state secretary in the finance ministry and is now a professor at Stockholm University. And finally, Kerstin Hessius was deputy governor between 1999 and 2000 and is now the CEO of AP3, the third national Swedish pension fund. So the panelists will get 5 minutes each for introductory statements, then we will have a conversation. And I hope that we will be able to take one or two questions from, not from the floor, but from the cyberspace. So please raise your hands and I will try to pick one or two questions. That being said, I now leave the word to Jesper Rangvid.
Yeah, thanks a lot, Peter. I hope I don't have to rewrite the paper, but I think it's fair to reassess and view it in light of the situation we're in, as you were saying, the corona situation. So I think I would like to, I would like to address it from 2 points, so to say, or make two, so we say, conclusions on judgments of the situation as it is now. I think as my main point in my paper, that is that the Nordic financial sector today is more robust than in 2008. and that I'm concerned about low negative interest rates. But let's skip that now, that the Nordic financial sector is more robust today than in 2008. And that conclusion, at least as the way things look today, I cannot see that conclusion needs to be changed. So that's the first part, and let me elaborate a little bit on this. I think what we're seeing right now is we're seeing it's obviously an unprecedented recession. The drop in economic activity has been so fast, and it has been so large that there's just no other recession that we can compare this with. It's much faster than in 8 and much deeper than in 8 and much faster than in 1929 and much deeper as well on the short horizon. And nevertheless, or let me say it in this way, had it been the same thing that had happened in 2008, banks would have, or another way of saying, had banks been as they were in 2008, I'm 100% sure that we will already now have seen interbank lending completely stopped. We would have seen banks really tightening their screws, cutting down on lending, and so on. I mean, the situation in 2008 was, on the shorthand, simply not as extreme as it is today. Then it's clear that in mid-March, there were lots of, we've almost, I mean, some people, or many people have almost already forgotten, but in mid-March, it's true, the situation actually did look critical. Spreads widened as they did almost in 2008 and so on. So there was a couple of days where it really looked critical. But it has pretty fast gone back to, I certainly wouldn't call it normal, because spreads are still a little bit elevated compared to before the corona crisis and so on. But there's no, I mean, banks are still lending from each other, and banks are actually still supporting the economy to some extent and so on. So actually, I would certainly claim that given what we have seen, I do think the financial sector is more robust than it was in 2008. Of course, that certainly does not mean that I'm pretty sure that we will not see challenges, because it's also clear, I think, that we will, I mean, there will be bankruptcies obviously going forward. What will happen in autumn, and that is very unclear. In particular, I'm quite concerned about the external effects that we could have. I mean, we have Southern Europe being particularly hard hit by the crisis, and frankly, I mean, they are very dependent on tourism and so on, which will certainly not recover. Many other activities will hopefully recover within hopefully not too far distant, but that will not. And many of the southern European countries, they will face even larger recessions than we are in. And we know that several of their banks, they are not as, should we call it, resilient or robust as the banks in the Nordics. And it's clear that if problems really arise in many of these southern European banks, that could certainly have spillover effects to Nordic banks as well. And I'm also pretty confident almost that we will see Nordic banks running into trouble. I mean, there will be Nordic banks in particular exposed to those sectors that are deeply affected, or relatively more affected by this than other sectors. Banks exposed to the retail sector, banks exposed to the tourism sector and leisure sector in general will probably face challenges. So it would be strange, simply given the depth of the recession, if we would not see challenges occurring in some banks. Of course, I'm here putting totally away. I'm looking aside from the fact that there could be a second wave of the corona crisis in autumn, and if that's even worse than one we have been through and so on, that's of course a completely different story, and then things will be even worse, obviously. But if we try to put that aside and see how does the situation look as it does now, and then I think that's my assessment, that the system is more robust than it is today. But that, of course, does not mean that we cannot see consequences for in particular some banks. And again, I'm a little bit worried about spillover effects from other parts of Europe. That's probably what I want to say in my introductory remarks.
Okay, thank you. I think in the interest of time, we go straight on to the next speaker, who's Lars Heikensten.
Thank you, Peter. I intend to bring up 4 different themes or discussions. And my intention is to be a little bit provocative, thereby hopefully contributing to a discussion. I will not only focus directly on the corona crisis, but also comment a little bit on report. And first, to the estimation of the costs from financial crises. You are writing, Jesper, that it might appear somewhat high, and in a way, I can see that. But in fact, I think that the costs are substantially higher, because we have a very long period with extremely low interest rates that I am sure have negative effects on efficiency in the economy. And we have not yet paid the price for getting out of this situation with these very low interest rates for a long time. And I fear that that might be quite costly also. And on top of that, I think that we have fairly high social costs. I mean, as we know, democracy in several of the Western countries are under threat in these days. And it's probably, not to a small extent, related to what happened with economic policy after the great financial crisis. So against this background, I might wonder if economists are not worrying too much about potential negative efficiency effects of measures to stabilize the financial sector. That would at least be my question. One should remember that this criticism of what is being done has a lot of power behind them, so to say, those arguments, in terms of banks acting very strongly politically in this area. Anyway, my second theme has to do with what you write about the stability of the financial sector. I tend to agree with the analysis as it is formulated, but I also agree with you that when you stress the importance of a long period with low interest rates, there are, I think, vulnerabilities in many parts of the economy. And we should remember that it didn't take more than hours until the financial markets were shivering in March when we started to see the consequences of the coronavirus. I recently talked to a friend in the central bank who said that they had 144 meetings since then internally on vulnerabilities in the system. And one might ask the question, do we have a stable system? Do we have enough buffers in the system if the central banks need to have 144 internal meetings on vulnerabilities over 2 months? Going over to the present situation, I'm not particularly worried, and I think that's your view as well, for a collapse or a breakdown generated from within the financial sector. This is not because as I already said, I think it is necessarily as stable as I think it should be. But I am pretty sure that central banks will intervene, and they will intervene massively. And I think that they will do it successfully if something will come up. My worries has more to do with the lack of buffers in private companies. Everybody is talking about the shale gas sector in the US as an example, but I would be surprised if we don't have quite a few actors in the real estate sector with similar problems. And in fact, I think we probably have it in all sectors. And how difficult this will be and what the feedback back mechanism from that can be is of course difficult to judge, and it will depend a lot on how long this process takes, obviously, and how deep the crisis will be. I also fear that risks are being built up in the financial market. So support is now given to almost all financial markets, including junk bonds in America. And the present crisis we see in the equity markets, I am sure, are partly related to believe that central banks will intervene and buy equity as well, if that is required. And the question, of course, here is how will this affect, or what effect does it have on the prices of risk? And is there any kind of happy ending of this process, and what does that happy ending look like? Finally, a reflection on policy also. Central bankers love a citation from William McChesney Martin, who you know who was chairman of the Fed in the 30s. And according to him, the role of central banks is to remove the punch bowl when the party gets going. My feeling is that the central banks are now pouring more punch into the bowls in a situation when there were already, at least if you look at it from an asset prices point of view, or talk about an asset prices party, when it was already going to quite a great extent. And removing the bowl, dealing with financial stability is now, at least according to the emerging consensus among economists in Sweden, something that should be done not by the central bank, but by an agency with close links to the Minister of Finance. That would lead to my last question. Should we be very confident that we have a good model to deal with the situation in which we are today? Thank you.
Okay, thank you, Lars. So then let's go on to next speaker, Karolina, please.
Well, thank you. I think I have fairly similar views to Jesper and perhaps also to Lars. I mean, I'm not terribly worried about a possible financial crisis in the Nordic countries, and that is for essentially three reasons. The first is what Jesper was talking about, that the banks seem to have been in relatively good shape at the outset of the corona crisis, or at least more robust than they were in 2008, certainly. Secondly, the Nordic economies are in most forecasts projected to be hit less hard than many other economies by the corona crisis. So if you look at the most recent OECD forecast, they project falls in GDP in countries such as France, Italy, Spain, and the UK of between 10 to 15%, while the projection for the Nordic countries is a fall in GDP of between 5 to 10%, which of course still is a pretty hard blow to the real economy, but in relative terms at least somewhat milder. The third reason why I'm not overly concerned is that the underlying public finances in the Nordic countries are relatively strong. So that means that the governments can lend support both to the real economy and to the financial sector, at least to some extent. They can give support in the form of guarantees and various other types of measures that take some risks away from the banks in this situation. I am, however, like Jesper, a bit worried about the consequences of the corona crisis for the larger European banking sector. Before the outbreak of the crisis, there were ongoing efforts to make the banking sector stronger and more resilient, in particular in the euro area, and this is related, of course, to the construction of the banking union. So these efforts were part of the plan to reduce risks in the banking union in order to be able to go ahead and complete its architecture, which would involve a number of additional risk-sharing elements. So this work took place in an environment with significant underlying weaknesses in the banking sectors in some parts of the euro area, notably in some of the countries projected to be the hardest hit regarding the real economy, such as Italy and Spain. So the question is, how will these countries be able to cope with increasing non-performing loans and mounting losses? Of course, measures undertaken by the ECB, which includes on the supervisory side, allowing banks to use capital and liquidity buffers, and on the monetary policy side, accepting riskier assets as collateral, and also to directly purchase risky assets such as corporate papers, for instance. So that will to some extent shield the banks in the euro area. But these are measures that, at least on the monetary policy side, they're not completely uncontroversial. They may become under fire if the ECB starts making large losses or inflation starts picking up. So for these reasons, I think there are reasons for concerns. Also for us, since problems in the euro area means problems also in the Nordic countries, whose companies rely on the euro markets, and I guess this could also, in some sort of roundabout way, affect the financial sector in the Nordic region. So I'll stop there.
Okay, okay, thank you, Karolina. And then on to Kerstin Hessius, please.
Thank you very much. Am I on now? Yeah. I will.
We don't see you. Oh, no.
You can't see me. Okay.
You are.
Thank you. I will put a little different perspective on this question, and maybe from the market perspective. And so I introduce my view on how the credit market is working during this crisis, and we come into this with banks and the financial markets. And from a market perspective, the worst is when everybody realizes a huge risk but have no idea about the magnitude. And under these circumstances, financial markets are not capable to price assets. And financial stability is a fact. And we were very close to such a situation in the middle of March, when country after country shut down by closing borders and quarantine citizens. And the measures to handle the consequences, in practice, the severe revenue drop in most industries, were far from enough. And at that situation, of course, credit risk increased instantly all over. And the credit market were almost closed for several weeks. Very few names could issue to a relevant price. And credit spreads increased substantially, even for companies who was among the few that was not hurt at all by the shutdowns. So there, in that press, you can say that the market didn't work at all. And funding in banks became, at that situation, very competitive. And the spreads between unsecured and secured credits went from negative to high positive. In practice, you can say that good names could borrow much cheaper in banks than in the financial markets. And that was a total turnover if you compare to before. All corporates with a certificate program used the revolving credit facilities. Lending and credit exposure in banks increased rapidly. And measures from central banks and financial supervisory authorities targeting the credit market through banks as liquidity support and lifting of some capital requirements are important for banks' capability to handle the new situation fast and efficient. But however, banks will not change their view on lending and add on substantial new credit risk. Their business model is developed for secured lending and closely controlled risk on their own balance sheet. Banks develop long-term relationships with their customers to manage credit risk. On the other hand, capital markets, they are developed for distribution of risks to a lot of investors, where each investor can carry a limited amount of unsecured and high credit risk. When the financial markets break down, there are no one else who can pick up that risk. So you cannot just move over the risk from the financial market to just some part of the risk, but not most of the risk. And in the secondary market, that happens, it was a lot of panic sell-off, and the panic sell-off came primarily from retail credit funds because of redemptions. And some of these sell-offs could be swallowed by institutional investors like AP3, but far from enough. And if you look into the credit market, listed corporates and also real estate companies with a credit rating, they just kept off the primary market during this period. They hold their breath, and they had both liquidity for some months, usually they have for 12 months, and banks as an alternative. So the most vulnerable are, and that goes without saying, small companies without credit rating, limited liquidity, and banking relations. For them, owners are the only alternative. They have a healthy business under normal circumstances, but cannot handle an instant revenue decline for months. And the only relative policy measures for them is cash support. The challenge is to find the most efficient controlled transition mechanism. So my view is that monetary policy and QE works well for removing excessive risk in the financial markets and support the capital markets and banks to act as normal as possible during stressed circumstances. But neither all companies nor financial markets and banks are capable to carry the whole increase of credit risk created by distance and shutdown measures. So policymakers must remove some of the risk through QE programs, cash support and guarantees. And I think if you look into the Nordic markets, I think the Norwegian central bank has maybe been the most efficient in trying to remove some of these risks in the markets, but still there is a lot of problems with distribution, you can say, support to the most vulnerable companies in the economy. And there, I think also we will have the consequences of the economic activity in the long run, the severe consequences. So I think we have not a toolbox to handle a situation as this when you have this very fast and we can say you don't know the duration of the revenue decrease for a lot of small companies that you don't have any channels to distribute support for them. So I think the US is maybe the only country that really have done a lot in this area, but we are far behind.
Okay, thank you, Kerstin. I think I'd like to take your comments back to the rest of the panel, and Jesper in particular. I mean, Jesper, when you discussed financial stability, it's very much focused on the banks. And what Kerstin now tells us, and I tend to agree, is that capital markets in general are at least as important. And then the issue is how much substitutability is there between credit markets and banks. And I understand Kerstin to say that there's relatively little substitutability. So in the end, if credit markets don't work well, it's the government in the form of the Riksbank or in the form of fiscal policy that has to step in. Would you comment on that?
Yes, I think the phrase generals have a tendency to fight the last war is important here, in the sense that the financial crisis in 2008 was a crisis, at least started in the banking sector. And therefore, we have had so much focus on strengthening the banking sector throughout the last 10 years. And that then raises the risk, of course, that risks, they build up somewhere else than in the banking sector. And both Lars and Kerstin has now mentioned a couple of this. Lars, you said, and I completely agree on this, that the debt levels in companies has risen a lot throughout the last several years with the very low interest rates. And academics and central banks have a tendency to focus on household debt. Perhaps we have good data there. Perhaps we have real estate prices typically was associated with crisis. And this is a new risk that we probably do not understand well enough, perhaps for data reasons, but we do not understand well enough and could be a clear cause of concern. And you, Kerstin, is certainly saying, perhaps risks are shifting away from the banking sector to other parts of the capital markets, and in particular, if capital markets do not function well enough when times are stressed, to take over the role of banks and extend credit to those companies that should have credit. That's clearly a cause for concern as well. As in some sense, that has been the whole point in the capital markets union in EU. That has been to say, could we somehow reduce the dependency of banks and instead increase the dependency of capital markets, or at least build better capital markets And I think it's fair to say that at least until now, that goal has not been met yet, at least. So yes, I agree on that as well.
Can I perhaps twist the question a bit and turn it to Karolina and Lars? What's your view on the regulations? After all, banks, as Jesper shows, are, due to the capital requirements, etc., much stronger today than they used to be. Wouldn't you expect then stronger banks to be able to take a bit more risks in these situations, to be able to meet the demands from small firms, etc., that cannot get funding in the regular markets? And related to that, how do you view the programs that, for instance, the Swedish Riksbank now is sort of allowing extra funding for banks if they pass it on to firms?
As I understand it, that is one of the facilities that actually have been used quite a bit. It's not easy, of course, to put banks under pressure to do more than what they think that they can do in the end. And I think I also think that it's a difficult question to know how far one wants to go in terms of guarantees. I mean, it's far from clear to me that. I agree with Kerstin that there seems to have been more done in some other countries, but I'm not at all sure that I think that that's the right thing. I think one needs to be fairly careful, and there will be very strong reactions among the population and also of the party leaders of those who are now asking for these supports when we see them. What will happen as a consequence of this in terms of mismanagement and so on. It's very difficult to strike that balance. How much should you spend on private companies without being able to get any receipts?
I mean, I agree with that. I mean, the banks, of course, they need to make some sort of risk assessments in these situations. Of course, there's a particular value for society that they would take risks in these situations, but they obviously will look at this more from a business point of view. So. For that reason, I think it's justified that you have these government measures trying to lift off some risks to incentivize the banks to extend further lending. I think there was also a situation during the spring where several banks were concerned about their liquidity situation because a lot of their customers were drawing on their credit lines. So I think they have probably made their assessments based on just general business principles. And in this situation, when from an economic point of view, you want them to extend credits to firms that face extremely uncertain future, then I think the government needs to step in and support this by various measures. Regarding the Europe is very it's a bank-based financial sector. Unlike in the United States, and Jesper mentioned these efforts to push credit market financing in Europe, and I guess one worry would be that this is not going to go very well, given that the capital markets didn't function very well at this situation. But you, Peter, you mentioned that the banks, they have been building buffers since the 2008, overall in Europe. So wouldn't that enable them to provide credit in this situation in a better way. I think one relevant aspect here is the low profitability of banks not in the Nordic region. I mean, profitability is relatively high here. But in other European countries, profitability is very low, and that also limits their ability to take on credit in a very risky environment.
So in a sense, the crisis comes at a time when we have a lot of structural change in the credit market. So the role of banks is in some sense diminishing, and at the same time, Kerstin says that we can't expect credit markets to function all that well in this situation. So that's a pretty sinister conclusion that all in the end all risk has to be taken by the government one way or the other. Would you agree to that? Kerstin is nodding.
May I just point out that what happens is that the credit risk, if you look from ceteris paribus before the corona crisis, the total credit risk in the market increased substantially from one day to another. And so all what the banks already have on the balance sheets, there's a big credit migration to lower or to higher credit risk instantly. And then you also should then your customers also come and ask for more credits. So you have this situation that the total risk in the banking sector immediately increases without any new lending. So in that perspective, I think it's very important to take away this countercyclical buffer and so on, because they have to handle the current situation just. But then thinking that they are going to add on a lot of new credit risk that they have not any relationship to, that I think is naive. That's my view.
Okay, let me switch the topic slightly. Much of the debate in Sweden and in other countries has been about household debt. There's been a worry that households are also highly indebted, and when the crisis comes, there will be negative effects because household saving will increase and consumption demand will fall. Now I haven't heard anybody of you talk about household debt as a problem in the current situation. Does that mean that the previous discussion was misguided? Jesper is smiling.
I mean, if I can,
sure.
Given that now it looks like interest rates are going to be super low for super long period of time. I mean, how could you? Then it's worrying about high debt levels doesn't seem to be of first order priority right now.
That was exactly what I also wanted to say, right? As I mean, interest rates are just going down, and it's clear that they will be very low for a long period of time. And when interest rates are low, then you can sustain a higher level of debt. So in that sense, it's probably not what is worrying us mostly at the moment. I think what is worrying us mostly at the moment, and that will be the consequences for firms or companies, as how many companies will actually be able to survive this after summer, and at least that's what's worrying me probably more than with respect to the household sector and the household debt level.
But we have a generation now growing up without knowing what interest rates are. Talking about risks in the future.
We are building up vulnerabilities, that's for sure.
But what we have seen so far is that saving rates have increased substantially in the household sector during this period of two reasons, because they don't consume and they also start to buy for the future, and they are worried about the future. So, and as you said, their revenues has not decreased yet. But of course, if the rate of unemployment and the consequences will be severe, of course, then we will have a problem. But that's later. I think it's very hard to forecast this right now because we don't know the duration of this crisis, and also we don't know how much how the labor market will work after the crisis. So I think still there is a big question mark what will happen with the household sector.
Okay, I haven't seen any raised hands, so I trust that's not. But there's now a chance if somebody wants to ask a question to the panel. Gisle, do I have it?
Yes.
Yes.
Yeah. I can ask a question. Or more of a comment on this thing about household debt, since that was my topic here. I think it's interesting to think about the distributional consequences. I didn't talk too much about that, but like one main point when we worked on the data for this issue was we spent some time looking at distributions. In the end, the graphs are mostly about means, but we had this distinction between movers and stayers. More generally, there are some life cycle considerations that are interesting, I think. So an environment with very low interest rates for a very long period of time, he talked about, that would sort of be to the benefit of people with very high debt levels going into the crisis. It's more unclear, I think. If you think of age groups, you typically see that people who have more debt are the younger ones, perhaps, or middle-aged, but also the wealthier people. So rich people tend to have big houses and big balance sheets and lots of debt. So I think that's. I don't think there's a clear answer as of yet, but there are huge distributional consequences of these very inflated balance sheets together with low interest rates that are a bit discomforting. I think they're concerning. They're not just looking at the mean levels of debt and aggregate demand like central banks usually do. I think that can be quite deceptive here. There are some big. So, for instance, if you think of this current debt crisis is one with huge distributional consequences. It's very heterogeneous. There's been some very nice papers from Denmark and Sweden on that, Andersen and et al. And there are some other papers from Norway looking at that. So, and of course, a small fraction of the population are being laid off, and they work in very exposed businesses. But those other households, they benefit, for instance, from low interest rates. So I don't know if low interest rates are actually a good policy tool in this crisis, because do they really solve the problem about distributions? And I have a question to you, which is slightly different, and that's about there was some talk here about the financial market distributing risk and so on. So my concern with the current crisis policies is sort of that they're not dumping enough risk onto the private sector, to the capitalists. So capital markets, if you live off capital income, you should not be insured by the government. Normally, that's the standard textbook view of the world. So you think of investors having linear preferences. They're not the ones who need insurance from the public sector, from the government. It's the human capital, it's labor income. That's very hard to insure privately. So there's a case to be made for insurance. But now it's sort of turned on its head, this crisis. So I wonder if you have any views on that. Why really, isn't it a bit concerning that we're dumping so much of the risk on the government rather letting the private sector, the capital markets, deal efficiently with it?
So who wants to pick up on that question?
Yes, obviously that is a great concern. And when it comes to, if you look at the problems facing the companies, obviously the owners should take responsibility for their companies. That's the sort of the first line of defense when it comes to protecting the companies. But then, of course, there is in this situation when you are hit by this crisis, and in some countries it's related to measures that keep people at home. They can't go to work, they can't go to the store. Then, of course, you want to sort of maintain these companies as to the largest extent possible in order for a recovery to be able to take place when you have control over the virus. So it is, I mean, the government needs to make that sort of trade-off. How much would they want to push the owners into potential bankruptcy and maybe then forego the possibility of having a relatively fast recovery? I mean, it's a trade-off.
That's right. Okay, no, but I also think this is a special situation, because if you compare with the global financial crisis 2008, the destruction of capital was made by you can say a credit bubble, and then you can say, of course, the owners should pay for it. But this capital destruction is caused by the measures to control the virus, and then you are in a total different situation where you don't have, you can say, a moral hazard problem in the same way, because and then it's more how to protect the labor market in the best way, and don't create a lot of capital destruction on healthy companies. So I think it's much more related to this. When should the central bank give liquidity support to a company? When you think it has an immediate liquidity crisis, but they have a healthy business in order, it's what you see today is that the very weak ones, they are the most downgraded, and the ones that actually will. I think we will see that a lot of companies will go into bankruptcy, but they were already on the weak part of the market. So I don't think the measures now taken will support the ones that was not able to be long-lived survivals. So I think it works quite well. I'm not so worried.
Okay, I see Lars has raised his hand.
There is a lot.
Jesper can get the final word, and then we have to stop.
There is a lot of talk about the consequences of the very high public debts that we are getting, and I think it's certainly worthwhile to worry about that. But on that, I can at least see, going back to history, several scenarios whereby this can be changing to the better over time. If you have a reasonable growth rate and you have perhaps somewhat higher inflation, as we had in the period after the Second World War, you can build yourself out of these problems. I'm not saying it's going to be easy, but I can at least see it. When it comes to these questions that we are discussing, I cannot see the way out. I see that we are time and again, are we taking over the role of the markets that we are supposed to sort of live on, and we put in money in it, and of course, as a consequence, people's behavior is affected. They estimate that the risks are lower, they will borrow even more, they will have even less buffers, and people have earned a lot of money on precisely those strategies, for example, in the private equity sector over the last 20 years. Why should they stop? So this, I think, is this sort of the big question for me is, where does this all end? And I realize it's not an easy question for a central bank. It's a bigger question than that. It has to do with our whole political systems. Traditionally, you had a political right, which was looking at the budget as something important in a country. Today, we have a right in many European countries who are even more eager to spend money than the leftists. I don't know how we get out of it.
Okay, does Jesper have an answer to this question?
No, I certainly don't have an answer to this, but it seems pretty clear. But also from the IMF and OECD and so on, we should all be Keynesians, right? And we should be max Keynesians at the moment. So it is the policy recommendation from, and it's clear that it's perhaps understandable in the long run, in the short run, of course, but it's certainly created some challenges on the long run. That I think is true as well.
Okay.
Maybe in the end we will actually have some inflation. I mean, that could be one possible outcome.
Yeah. Okay, so that's the end of this discussion, and I guess it ends with huge question marks. So the future is more uncertain than we used to. Thank you so much. Thank you to all participants in this webinar. And let me just end by saying that this is an event that recurs once a year, and next year we will take on the housing market. There will be hopefully a conference during the fall and a new issue of Nordic Economic Policy Review coming out next spring or early summer. Thank you so much. Goodbye.
Thank you.
Thank you. Goodbye.
Thank you.
Thanks.
Thank you.